What's up everyone? Welcome to Investing by the Numbers. I'm Simon Thompson, and today we're going to cover one Canadian dividend stock that I believe is undervalued right now. This is a small cap stock, it's relatively unknown, and it has the potential to double or even triple in the next 2 to 3 years as the market rebounds, so stay tuned. So the stock that I'm talking about is Chesswood. That's CHW. And this is a stock that primarily leases equipment to small businesses. So it's really been hammered, and you can see in the chart here that the price action on it has been very interesting. I actually owned this stock pre-crash, and of course I lost some money on it. I was selling it a little bit over $4. It went all the way down to $3.50 as you see there. And it bounced all the way back up to $6. I sold some more of my position there, so I got out at an average of about $5 or the high fours, and now it is back down to around $3.50. And so this is a stock that is down 66% from earlier this year. It has traded in ranges of as high as $14, but kind of in the $10 to $14 range for several years. It's a really high dividend payer, but they've actually completely cut their dividend recently, although I do believe that will come back. And I'm going to show you exactly why I'm buying this stock now and looking forward to the potential upside as the economy recovers over the next year or two. So let's deep dive. So Chesswood is a company that leases equipment to small businesses. So you can think of restaurants or breweries or construction companies, and they essentially borrow to buy that equipment and then lease it out and get a return on that. And they say here that the dividend's at 10.77%, but the dividend's actually been fully cut. That happened somewhere over here. And I owned this stock pre-crash. Obviously, that's not so great, but I sold off most of it here at about $4.24, and I've been playing a little bit of this swing trading game here, which I'll explain later. Looking at the Morningstar financials, we can see that Chesswood's revenue has been rising consistently. It fell off quite a bit in 2015, and we have to go back into the financials to discover why that is, but the net income stayed actually much higher that year, so I'm going to assume that it was because they sold off some part of their business that was less profitable, and since then their revenue has been climbing substantially up to $95 million in the trailing 12 months. Their net income has been solid except for the most recent quarter, and 2019 was a bit more difficult, which we will explore. And the dividends have been raised consistently over time, which is great. They've been investing into growth recently, so they haven't raised their dividend in the last few years. And then we can also look at their book value, and their book value per share is sitting around $8 or $9 in 2019. And of course, it's trading at $3.50 or $4 at the moment. And then we can look at the free cash flow here, and it's actually negative. So we'll explore that a lot more later. And I want to try to look at their potential payout ratio based on their free cash flow. And we have to understand, obviously, why that would be negative on this sheet here. The next thing I want to look at is the return on equity, which has been very solid for them over the past 10 years, averaging of about 15%, except in the most recent year. As I mentioned, they had a more difficult 2019, and of course the most recent quarter has been very tough for everyone, especially for them since they're lending to all these small businesses that are having their businesses massively impaired by the COVID situation. So looking at a quick snapshot of their financial health, we can see that they have very high liabilities, high debt, and we'll take a closer look at that. So their debt has been rising significantly over the past few years, and this is partly due to the nature of their business. When a new client comes and they don't have that piece of equipment, what they do is they borrow to buy that piece of equipment, and then they are effectively leasing that equipment and getting cash flows on it over time. And we can see here that their cash position is quite weak at only $24 million, and most of their assets are the receivables, so this is what customers owe them. So obviously the success of their business really banks on their ability to collect that, and their debt is at $815 million. So if you follow this channel at all, you know that I like to invest with companies that have strong insider holdings, and you have to keep in mind that their ownership here is actually significantly lower than normal. that would be about triple. So it would be closer to $2 million for the CEO in stock, common stock value, and of course about $1.5 million for the director of finance, Lisa Stevenson, who's been with the company for 18 years. And on the board, you have Edward Sonshine, who owns and runs RioCan, and he has $7.7 million in the current stock price value, as well as Frederick Steiner, who has $4.9 million. Again, that would be normally triple before the crash. So they really have a very significant stake in this business. So after a long period of silence since March, on May 13th, they came out and said that they were going to be recording a $15 million non-cash allowance loss. And that essentially is where they put that loss on their books, and they're expecting to lose around $15 million on bad loans. These are customers who won't be able to pay and will default on those loans. Now, that is a loss they get to take now, and it will be either realized fully or potentially even more people will not be able to pay, or potentially less. So that is something where we will have to discover what happens in the next quarter here. They also mentioned that they are writing down their value of their company Blue Chip, which is one they just recently acquired. And so this is also a non-cash loss, and it goes on their balance sheet. It's the impairment of goodwill, which, if you don't know what that means, goodwill is just an intangible value that is associated with a business. And so this is part of their non-cash loss that they had to record a big loss this quarter. And they also described that they were going to be reducing their dividend at first, and then on May 19th, they decided to cut their dividend entirely, saying they were temporarily suspending it. They also told us that there was going to be a 20% reduction in management compensation and temporary halt of payments to director compensation. So during the first quarter, the company sustained a net loss of $19.8 million, and this was primarily due to the goodwill impairment that we see here. So that's a non-cash item. They're just saying, okay, we think our company, Blue Chip, is worth less. And also the provision for credit losses, which is at $24 million. Now, this is significantly higher than normal. You can see over here in 2019, their quarterly provision for credit losses was $7.3 million. So this is a normal part of their business. They're doing higher risk loans to small businesses who don't always have great credit. And in this case, they had to increase their credit losses substantially. So their losses are really already baked into the share price as it is right now. And also, it's important to note that these are a guesstimate of what they think they may lose, and it could be worse than that, or it also could be better. So next, I want to take a look at the consolidated statement of cash flows and just show you quickly how it's really a bit difficult to calculate their free cash flow just from the Morningstar sheet that we saw. So they had free cash of $97 million, and then it gets adjusted by this big number here, $442 million. This is the funds advanced on origination of finance receivables, which is just a fancy way of saying they're borrowing in order to buy those assets, in order to buy the equipment and then lend them out. And there are also fees associated with that. This is the origination costs paid on finance receivables. And then they have, of course, collections each and every year that also affects their cash flow. So it's a bit difficult because they have a negative cash flow here of $102 million, but this is essentially because their business has been growing so substantially. They are borrowing more and more in order to buy the equipment, in order to lend it out. So we got to take a look at their cash flows from another angle. So due to the unique nature of the business, what Chesswood does is they give us their version of their free cash flow. Now, this is a non-GAAP measure. GAAP is, of course, a generally accepted accounting principles, and they essentially say that their cash flow in each and every month is $5.8 million roughly on a quarterly basis in 2019. So about a total of $24 million, and they're paying out about $15 million in dividends, or at least they were before they cut them. And the reason I'm going through this is just to kind of see what their payout ratio would be during normal times. And so if we do the math on that and we take their about 15 million that gets paid out in dividends and we divide it by the 24 million in free cash flow, we actually get a payout ratio of 62%. So this is actually what I would use to measure the payout ratio of this business, which is very solid. But of course, this whole business is dependent on the customer's ability to pay the leases. So finally, I just want to discuss why Chesswood had a tougher 2019, at least on paper, with the lower net income. So they continued to grow. Their net income was significantly lower. And this was because they launched Tandem Finance in 2019. It went from 0 people up to 14 or more staff and 30 million in originations. And they're very excited about this company because it operates in a market that is 5 times larger than Pawnee. And Pawnee is the major source of their revenue. It's their core business that they have inside their group of companies here. And now this is a business, Tandem, which is willing to lend all the way from prime credit rating, so A+, great credit, through to C credit rating. So they're willing to take even more risk and lend to startups and others who potentially are less creditworthy. Now, if they're doing their job correctly, they are lending at a higher interest rate to account for that risk. So we'll see how that plays out. But this is a big part of why they have been less profitable this year, is because they've invested a lot into this new business, along with the acquisition of Blue Chip in a recent year as well. So these two efforts have been slowing down their efficiency, slowing down their net income in the short term, but giving them long-term growth potential. So obviously Chesswood is a bit of a riskier play. They're very exposed to COVID, whether it spikes up again from a reopening or in the winter with a second wave. And it's a situation where, they're not paying a dividend. So if you're looking for that, this is not the stock for you right now. But I am playing it in a way where I'm going to swing trade it. I'm going to look to take profits at about $4 if I can, and buy it around $3.50 and below. And if I get caught on the other side of it, where it just stays low at $3 or even as low as $2.50, who knows, I will be holding on for the long term, because I do believe that there's a strong chance they're going to succeed. They're a well-managed company. They've played defensive by cutting their dividend. They have taken a cut to their own management fees. The board of directors is not taking fees right now. So they're really doing things in a smart way for their long-term success. And in Q2, when we get another report from them, we're going to find out how many of their customers who had deferrals are continuing to pay, and that's going to be a big period of time. So I'm very comfortable with trying to take some profits in the short term in that 2-month window that we have before the report next, where it's mostly uncertainty and people are trading on emotion. And if I get caught, like I said, on the other side of things, I'll just hold for the long term and believe in the company. As long as COVID doesn't come back super strong, in that case, I would sell, because it's going to really hurt this business, since they have high debt and they're really focused on being able to collect the lease payments from their customers. That's obviously their core business, and they don't have a lot of cash in the bank. They don't have a ton of cushion. So it's a situation where they're borrowing to survive, or in this case, really just cutting their dividend and cutting expenses where they can. So it's a situation where I do believe that they will thrive over the long term, and I'm going to try to play the game on the short term here. All right, guys, that's a wrap on Chesswood. Hit that thumbs up button if you got some value, and leave me a comment below. Let me know what you think of this company, if you're considering investing, or if you think it's too risky, or if you think there's any holes in my analysis. I'd love to hear from you guys. You can also check out more content. I have tons of videos on dividend investing, value investing, and swing trading. So be sure to check that out, and we'll see you next time.